Welcome. I'm Ira Epstein, and I'm here in my recording studio, and I want to talk to you about the VIX soaring sixfold from just July 19th to today, August 5th, 2024, and stock indices, which have been going up, and away, suddenly entering, in many cases, correction territory. What's going on? Well, to a large degree, we're entering a mid-cycle. Now, what is a mid-cycle, you might ask? It's after a market goes up or down a lot, and it gives a pause by reacting. And what's happening here in the stock market is here we are in the summertime, early August, if you will, from when this period of time began that has actually shook the market up to where we're at right now with the correction of sorts taking place. Okay, it's necessary. Nothing rose to the sky. Is it the end of the bull market? Why is it taking place? Is there a fundamental change going underway? And will the market recover? Isn't that a mouthful? I'm holding down on this chart, showing you the low point in the VIX, and you can see it was just over the 10 level, barely. And all of a sudden, the market comes up here today, 65.73. What the heck happened? Is this the end of the earth? You know, when you get up into the 70s zones like this, it's often a sign of correction activity taking place, which we've had. This has all happened in 1 8-hour session. Now, let me explain this. We have gone already from 65 back to 34. So it's an elevated number as to where the market has been, because it's been trading between the 10 level, as you saw, and basically 14 for a very long period of time. So something must have occurred. And that something, as you can see here, took place as the markets were going up, and away in July. And as we entered the period of August, all of a sudden they fell down. Now, it's important that you take a look at the chart action right here and the gray lines that you're going to see on each chart. This is the 200-day moving average of closes. If my eyes leave, because I want to be certain that I'm pointing right to you. Take a look at what went on in the NASDAQ. You're over a 10% correction, by the way. So you've entered what we call corrective territory. If it dropped 20%, then the market would be called in a bear market. If you take a look at the Dow, take a look at the number, the gray line, you went to the 200-day average. And if you take a look right here, you see the S&P did. And in most cases, these markets are trying or have held the 200-day average of closes. So why is this all taking place? So what happened? Well, I think two things have happened. Number one, I think the market was just playing due, as so many other analysts do, for a correction. What would set it off, when it would happen? Well, if we knew that, we'd be billionaires, maybe trillionaires. You never know that. You know that after the fact. Sometimes you guess it right, sometimes you don't. But what happened if you look at the current jobs report that came out on Friday? You have a pretty good inkling. The market was shook by only 114,000 jobs. Normally, that's a good number. Pre-pandemic, 114,000 is good. But the market was looking for 185,000 from CNBC, 175,000 from Bloomberg. Then the market, instead of a 4.1% unemployment number, as many analysts, the vast majority were looking for unchanged from the prior month, went up 0.2%. And then we look at a 27,000 number, 26, 27, reduction from June in jobs. Spooks the market big time. We did not see wages go up if you look at the last two numbers in any measurable manner. If anything, they went down. So why did we lose all those jobs? That becomes one of the big questions that I think you have to. And the Bureau of Labor Statistics gave us the answer. Hurricane Burl. Take a look at how many thousands of jobs people could work at when the hurricane hit Texas. 461,000 jobs. Let me ask you a question. How many of those do you think will come back now that the hurricane is come and gone? Could be a lot of them. What's a lot? Could it be all? Could it be half of them? It's some big number. So I'm looking in August for that number to be revised to a degree. And what else? Today, the 5th, what held the market and helped it hold the 200-day average of closes was the ISM number, which shows, as you can see, your expansion in every category. Now, the market did get spooked in July when the one big part of our economy, the service sector, went into contraction mode. Any number under 50 is contraction. All of these numbers came back up. Now, I don't know if they'll stay up, if you will, for the month of August. And when we get these numbers that come out at the beginning of September, will be up or not. What I do know is that this morning on CNBC, you saw Jeremy Siegel, other analysts saying the Fed is late. They should have moved earlier. And now they should go big, 50 basis points in an emergency cut, not waiting for September. I think that's totally the wrong message the Fed will send. I don't think that one report is what you act off if you're the Fed. I think what you act off of is simply you look at the data, you make your cuts, you know you got to get ahead of the curve. One of the ways to do that is consider a 50 basis point cut in September after you see more data coming your way. As for running after the market and making an emergency cut, I want to go on record. I don't think that's going to happen. I'm Ira. You have yourself a great trading time.